Today we explore 10 reasons why we all need a little more gold and silver. So let's dive on in. Now, this channel provides global macro insights and champions the notion of sound money, so do consider subscribing. But let's start in ascending order at 10. So at 10 we've got the potential for precious metal shortages given the disruption caused by the pandemic. This is reinforced by the fact that mining is the most capital intensive of operations, and precious metals have been through a serious bear market over the last 10 years. This has resulted, according to many mine experts, in a low level of capital investment. Both points together suggest that the supply curve for gold and silver is supply inelastic. Now, this simply means that if the price level of these metals rises by 20%, then supply only may rise by 5% or so. At 9, central banks globally are planning and are determined to give us a cashless society. The war on cash has gone nuclear in recent months. This then enables an Orwellian-style surveillance state where the introduction of central bank digital currencies by the supposed bank regulators removes any real need for a banking system. After all, a central bank digital currency is a claim upon the central bank. At 8, and a very much related point, is that the most easily confiscated money, as we have seen in recent crises in Greece and Cyprus, is through what Jim Rickards has referred to as ICE 9, the freezing or even the outright seizure of bank assets. According to Jim, this could even extend to the freezing of financial assets so that they cannot be sold. Meanwhile, Cyprus has already shown us that bank deposits can be seized in a one-off financial or wealth tax. In the face of an even bigger surveillance state, gold and silver act as a crucial store of value outside of the banking system. At 7, we still face the prospect of economic chaos. This point is lost on so many, and the rapid recovery in stocks has led many to conclude that we face a V-shaped recovery. Unfortunately, a wide array of economic headwinds still exists, as we can see here. While central banks have done all they can to actually try to get ahead of the curve, these challenges are not easily resolved. Thus, there is still a great prospect for market crashes and economic strife. Absent of any counterparty risk, gold and silver provide rare safe havens, while traditional safe haven assets such as treasury bills continue to rise dramatically in their supply, given the extent of deficit spending. At 6, investment assets go through changes in their fundamental intrinsic value. While boom phases in the economy will see company earnings soar, high cash flows and strong dividends for stockholders, holding gold and silver at these times presents an enormous opportunity cost for the investor in terms of foregone earnings. Yet as the economic environment deteriorates, many companies will enter a period of retrenchment, profits and cash flow decline, and scale is withdrawn, while stockholders will face, at the very least, lower dividend payments. Reduced expected outcomes causes a fundamental change in the intrinsic value of such items, while items free of counterparty risk experience a positive change in their perceived intrinsic value. As we can see in this chart from the 2008 financial crisis from economist Paul Miller, with gold in green, equities in blue and bonds in red, and this fits perfectly with the principle of John Exter's inverse pyramid, where investors run from risky illiquid assets towards the safest, most liquid assets, gold and silver. At 5, fiscal deficits continue to rise, and this is sending national debt soaring. The consequent supply of treasuries or bonds grows ever larger, which is likely to require ever greater roles for central banks in managing the entire yield curve, the entire range of treasury bill maturities and their yields. Yield curve control results in artificial suppression of the interest rate, and given gold has no yield, this is very positive for gold. Indeed, our fourth point is that we are in the era of zero or even negative real interest rates. Savings and the time value of money is now zero or worse. This leads to a complete mispricing of risk, which encourages far greater risk-taking, speculative activities and malinvestments. Meanwhile, no time value on money substantially reduces gold's opportunity cost. At 3, we have the spectacular rise in money supply that has taken place globally. We are now in the era of QE infinity. What's more is that this is just the start. MMTers are keen to talk of deficit myths and how fiat currency can be used to right the wrongs of the inequality that the system of fiat currency has actually brought upon us. Currency debasement of this kind will continue to send gold and silver ever higher. At 2 is financial repression. This is the key means by which authorities will try to keep a lid on the public finances. Financial repression involves the transfer of private wealth to the public sector via means such as zero or even negative interest rates. It combines currency debasement and zero interest rates to help generate inflation, which is the easiest means by which authorities can secretly and unobserved reduce the real size of their national debts. Of course, it will reinforce wealth inequality and continue the attack on the middle class. Finally, the biggest issue, number 1, it's one of trust. Trust in central banks, global authorities and their fiat currencies continues to wane. What's more is that their very own faith in their paper currencies is also declining, and this is why we see central banks shifting from their currencies and US treasuries towards increasing their gold holdings. This growing lack of trust is set to accelerate as deficits soar and financial repression takes hold. Ultimately, it will see the end of the dollar standard as we know it and require a complete monetary reset should trust be completely lost. So here's my list in full. I'd love to know what you think. Is there anything I've missed out? Do let me know in the comments below. In the meantime, do check out these other videos and I look forward to seeing you next time. Bye bye.